always thought negative gearing was the way to go until what you said.
Yeah.
There is no right or wrong way, like what you just said just then.
Yeah, so there's different strategies when it comes to property investing, right?
Mm.
So if you're looking for a negatively geared property, it means you want to reduce your taxable income.
Yes.
But that means your taxable income has to be extremely high, right?
It's
It
above
has to be-
100K.
100 is average these days,
Yes.
right? It's not high.
Mm.
And you're doing it from 2 jobs. So if you're working 2 labor jobs,
Mm.
you're putting in twice the effort to make 100K.
Mm.
Do you think that negative gearing and the additional impact on your income is helpful to you? So you might make money still in the 10, 20 years from the capital appreciation, but what if the interest rate goes from 4 to 8%? You'll go from negatively geared to really negatively geared, and in terms of cash position, you're always going to be putting money in.
Yes.
You'll never be taking money out.
Okay.
And then you've already maxed out on how much money you can make based on your time. The only way you can make more money is either increase your skills or sell more of your time.
Yes.
You've already sold the maximum of your time.
No, I was thinking you have a mortgage, right? You pay into the principal.
Mhm.
Obviously, you don't just pay the interest, or else you get nowhere, and it will grow. And you use that money to, like what I said just then, negative gear, so that when the tax time comes, you get a portion of the money back, and you either reinvest it into the property so it pays off sooner, or like put it into another property or
Yeah.
something like that. Yeah.
But the tax saving,
Mm.
it's like, you lose a certain amount. Say you made a taxable loss of $10,000, right?
Yes.
It will reduce your taxable income from 100,000 to 90,000.
Mm.
So your tax saving will be roughly, say, 34%,
Okay.
3,400.
Yeah.
So yes, you've saved 3,400 in taxes, but you're still losing money.
Yeah.
You could be making it back in the sense that the property will be going up 100K per year, but then you will always immediately be out of pocket. So the flip side to that is stress-free, positively geared properties. So you want the rent to cover all your expenses. That way, even if you don't put $1 in, it's okay, it covers itself. And then say if you lose your job, you want to go back to one job, you can.
Mm.
If you go negatively geared, you can't go back to one job because
Yes,
you still need the money.
that's right. You need the money to pay off.
Exactly.
Yes.
And then
okay.
when you compare a negatively geared property and a positively geared property, that's just a cash position, but the capital appreciation on both properties could be the same. So if you're especially because you're working a labor job,
Mm.
you can't trade any more of your time. And then the more positively geared it is, the more serviceability you get, and then you can add that to get your next one. The negative one will just eat up your serviceability, and then you just buy one, you park it there, that's it.
Yeah.
But obviously there's a medium and long term end goal to this.
Like I just started doing 2 jobs, so I never really paid this much tax. And this year, according to my tax return, I'm meant to pay another $3,000 extra. Yeah. So I was just thinking of ways to cash flow because of my HEX. I had to pay part of it, so that's why I got this mortgage to pay off my HEX also, since the interest rate of the loan is cheaper than the interest rate of the HEX because of inflation. Yeah, so that's what I did, and hopefully this might reduce my tax even more.
So when did you buy the property?
I just signed the papers like last week.
How many properties do you currently have?
Nah, this is my first one.
Your first one.
Yeah.
Was
so
this property passed to you?
yeah. It's transferred to me at 510,000. So for a period of time, I was trying to find out whether I pay tax on the market value or the transfer value. And I'm getting mixed answers from all sorts of accountants. The ones at Cabra are saying like, oh, it's still a sale, it's not a transfer. You pay capital gains on the market value. And a few at Bankstown were saying like, no, it's a transfer, so you pay off the transfer value.
Yeah.
So they're like, so which was right, which was wrong? And one of the guys was like, you know what, just try and then you'll find out. And I was like, you can't just do that. It was like, what happened if the market value? No,
It's market value. It's called the market value substitution rule. So to prevent people from playing with capital gains and capital losses, because if I got a property for say 100K, I sell it for you for 1K, if it was for transfer price, I would have realized a $99,000 loss.
Mm.
So the tax system was designed not to let us to do that. So the market value substitution rule means that you should get a market valuation at the time of sale. That will be your backup document. Otherwise, your only points of reference are similar sales using the historical data at that time.
Yeah. So they brought that property like 15 years
Oh,
ago.
you mean the cost
Yes.
price?
Cost price was 490,000 excluding stamp duty,
Mm-hmm.
and the transfer value transferred to me is 510,000, whereas the market value is 850,000.
Just 850.
Yeah.
Well, was it a rental or did they live it?
It's a rental.
It's a rental.
It's a rental, yeah. After all the calculations that I did, after I got it, I still have to pay an extra $400 in it because of the interest rate. Back then, it was more than enough. We even had extras too. But like now with today's interest rate, yeah, I have to pay more in it. Yeah. So right now, my situation is like with 2 jobs, I'm paying a fair amount of tax. Is there any way how I can reduce it or like do anything with it? Because everyone's saying something different. My colleagues, or like if you go to a good accountant, they'll find ways to help you get some back.
Mm-hmm.
Yeah, and other people were like, it's the ATO that they're not gonna lie to you. You just give out whatever and then they'll return whatever. Yeah. So I don't really know where do I even stand.
Yeah.
Yeah.
Okay. So look, tax is like very definite when it comes to individual taxes. You earn a certain amount on your income, you can deduct what they allow you to deduct.
Yeah.
So if everyone was at a equal skill level when it comes to tax knowledge, they'll all get to the same answer.
Yes.
They come to different answers because the knowledge level is very. I might know a rule that you might not know. But it doesn't mean that if you come to me, I can get you more than you do it yourself.
Yes.
If we're both understanding what you're claiming and how much you're making, we should get to the same answer.
Yeah.
So really there's nothing that you can do to reduce your taxes because it's very definite. You follow, it's like doing a math test.
Yes.
You
But
present the facts.
Yeah, but there are some that confuse me. So like my girlfriend's tax agent was like, you can claim back your fees from your phone and fees from your petrol. And I was like, wait, hang on a minute. How do you differentiate the difference between using your car for work and car for work? I mean, car for work and car for your own personal life.
Yeah.
Yeah. So how do you even differentiate that? And she's like, I don't know, the tax agent just did it.
Yeah, so that's not the proper way to do it.
Yeah.
So there's 2 methods, right? There's the actual method and there's the estimation method. So actual method is you would have a logbook
Yes.
to determine the percentage related to your business usage. So say if you traveled for work, 50% of the time, the logbook should be reflective of that. And then we would add up all your expenses like petrol, regio, insurance, and repairs, maintenance, add it all up, multiply it by the business related usage and would claim that amount.
But this isn't even a business. She's a laborer.
Yeah, but if you use it, when we say business related usage, like related to your job,
Oh, so you can do it.
you can do it. But
Okay.
it's only like say if you're a physiotherapist, usually you work on site, you just travel from home to site, that's not deductible. But if you're a mobile physiotherapist traveling from the office to a client, that's different. That's called business related usage. The second method is estimation method, which is a set rate based on the number of work-related kilometers traveled. So for every kilometer, it's 72 cents.
My uncle, this is my uncle's tax. Like it was done by someone at Cabra.
I mean, where's the rest of the tax return?
That's it.
That's what they gave you?
Yeah, that's all they gave us.
It's not even the full form. You know? Like how are you meant to know
Yeah,
what you're signing off on if they haven't given you the full tax return?
that's all that was given.
Yeah, well,
Yeah, they were like, you gotta pay this much because of the property. This is what would have happened if you didn't have the property.
you don't even know if they put any deductions in at all.
Yeah, exactly.
So pretty much what I want you to take from today is the same thing you want. You want to improve your skills, you want to make more money, right?
I agree. Yeah. That's why like I'm always looking. I'm always trying to find ways, like even if it's half a step, I'll
Yeah,
take it.
But then even if you take your next role, you need to stick with it. So say for example, I took a very different approach. I've worked as toilet cleaner, McDonald's, car wax salesman at the petrol station, right? But after that, I realized you need a skill. So I stuck with accounting for 6-7 years. I opened up my own practice. That's a pathway, right? So it's the same thing with you. The next thing you choose, don't let it be a temporary thing. The goal here is to be smart about it, make money, and then do what you want. Because like the truth of it is, most of my clients here are property investors. I make more money from property than I do accounting.
Tax wise,
Yes.
what should I be doing?
Tax wise, it's very straightforward. If you're an employee, the only things you can do to reduce your income is spend money on work related stuff, which you don't want to do because you'll be out of pocket anyway.
Yeah.
The second thing is salary sacrifice. If you're on a low income, you don't want to be salary sacrificing either because that's taking away from the money you have now. So the steps that you want is first make a lot of money. Once you've made a lot of money, make a lot of money outside of super for your immediate benefit, because you need a safety reserve that will guarantee that even if you lose a job, it'll take you 4 weeks to find another job.
Yeah.
Worst case scenario, 2-3 months, but you need to have that amount of safety net, right? And then after that, if you've got more than enough money outside of super, you start using super, because if you're investing, you're not going to touch it anyway.
Yes.
So might as well put it into super and get a tax saving.
Yeah. Is super tax deductible?
Super is not tax deductible because it's regarded as a separate entity, right? So you got to think of superannuation as a separate bucket. You put it into there, it's separate from you as an individual. Your contributions get taxed at 15%. So if you're on 100k paying tax at 34.5%, the difference, it's like 17% instant savings, put it into super.
Yeah.
But the thing is, you can't touch that until you're 65.
Like you put into super, you get it eventually.
You get it eventually, but you might die before 65. What about when you're 30, 35, mid-30s, you have a family? You want to have money to take them on holidays, give them a lifestyle, right?
What you said does make sense, because my way, like, yes, I am getting some tax back, but in the long run, I am spending more money. Yes. So I understand that.
And then if you put money into super, yes, you pay more tax, but you're giving up the accessibility.
That's right.
We value the accessibility now because money is more valuable when you're young.
So in this situation, I shouldn't be spending more than what I should.
I mean, if you can afford to live at home, because the chances are that you save 20k on rent per year, in 5 years you've got 100k.
Yeah.
That's the deposit for your next house. Look, a good example is the first property I bought in Fairfield Heights, right?
Yes.
I bought it for 830k. I get 600 rent per week, which is 2,400 a month, right?
Yep.
The interest is about 1,800. So just keep it simple.
Yep.
I pocket 600 bucks, right, per month. So in a year, it's 5k right in my pocket, right? I've held it for 2 years now. So I've pocketed 5k in year 1, 5k in year 2, but now the value is worth $1 million, say $1,030,000. So every year went up 100k.
Yep.
Right? So I earned 200k in unrealized gain, and I also pocketed 10k physical in my pocket. Right? Do I care about tax on that 5k? No. I care about the tax on the 200k that I made unrealized gain. But the trick to property is that you never realize the gain.
Yeah.
When the property goes up in value, we borrow against the appreciating asset, and we do a cash out. And we take that money, we buy something else. Because if we don't sell, we don't pay tax.
Yes.
So yes, you could call it delaying. But if I hold it till I die, and then I have no kids, if I have kids, I'll pass it on to the kids. They can deal with the debt.
Yeah.
If I have no kids, give it to the bank.
Yeah. That was my plan. Yeah. Thanks for your time, bro. I really appreciate it. Yeah.